With a recent rise in interest rates, savings rates have been boosted from 3% to 9%. We're going to explore the safe, high-yield USA Treasury rates and more, so stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. We got some exciting news here today. If you have money sitting in the bank and you've been waiting for higher interest rates, well, this may be your opportunity. We're going to look at some possibilities I think that'll give you a much higher rate of return on your money. Also, on this channel here, be aware we cover all types of financial issues: Social Security, investing for retirement, saving for retirement, when to retire, and much more. Here's a recent headline: nearly risk-free I bonds to deliver a record 9.62% interest for the next 6 months. We're going to take a look at the best interest rates available right now and also these I bonds. And then we're also going to take a look at some strategies you might want to think about. Let's first review what is Treasury bills, Treasury notes, and Treasury bonds. Treasury bills are issued with maturity dates of 4, 8, 13, 26, or 52 weeks, typically 1 year or less. Treasury notes have maturities of 2 to 10 years, and Treasury bonds have maturities of 20 to 30 years. So Treasury bills are shorter term, Treasury notes are intermediate term, and bonds are more long-term maturity investment. Let's take a look at our current Treasury yields here. They're much improved over the last 3 or 4 months here. A 12-month T-bill is 2.80%. A 2-year T-note is 3.18%, and a 30-year T-bond is 3.28%. If you have some of your own ideas on how you would implement this, leave a comment. Let's take a look at this Series I savings bonds. One of our viewers brought this to my attention. I thought I would share this with you. But right now, the rate on this is 9.62%. That's pretty strong here. Now, the rate on this is good through October of 2022. They reevaluate the rates every 6 months, in October and in May. Here's what they say: I bonds can be purchased through October 2022 at the current rate. The rate is applied to the 6 months after the purchase is made. For example, if you buy an I bond on July 1st, 2022, the 9.62% would be applied through December 31st, 2022. Interest is compounded semi-annually. One thing to keep in mind on I bonds: you can purchase up to $10,000 in electric I bonds each calendar year. So that means once a year you can purchase $10,000 worth of the Series I savings bonds. We're going to look at some strategies using this here in just a moment. Now, you can purchase these along with bills, notes, and bonds through the Treasury Direct website, treasurydirect.gov. What you want to do first thing is you set up an account, and then you can go through the purchase process. The I bonds are sold in 5 denominations: $50, $100, $200, $500, and $1,000. Now, how much can you buy again? Through the Treasury Direct, $10,000 maximum. However, if you have a federal income tax refund coming, you can buy an initial $5,000 in Series I bond. I mentioned the Treasury bills. These are short-term instruments, 12 months or less. Now, when you buy these, you'll either use a non-competitive bid or competitive bid. Most of us, like myself, going to use the non-competitive bid. You set up an account. You go through the process of buying. I mentioned Treasury notes. Now, Treasury notes come in 2, 3, 5, 7, and 10-year maturities. They pay interest on a semi-annual basis. And then when the note matures, the investor receives the full face value. There's also been some improvement in the money market rates. Here's an example with Citibank. It pays a rate of 1%. Now, I know you have to laugh. I mean, that's pretty low. Under our current situation we've been under the last few years with low interest rates, 1% sounding pretty good these days. Some other money market rates to think about: Capital One's paying 0.9%, and Marcus by Goldman Sachs is paying 0.85%. We're going to take a look at an example investment strategy here to take advantage of these higher interest rates. Here's an example of someone that has $300,000 saved up, $200,000 earmarked for investments in stocks or ETF funds, $100,000 earmarked for savings in CDs, bonds, or money market funds. So we're going to use $100,000 total total savings to be invested here. In this case, we're going to have $75,000 in a money market fund. We're going to put $5,000 for right now in a 12-month T-bill, $5,000 in a 2-year T-note, $5,000 in a 5-year T-note, and we're going to go ahead and do the I-bond with $10,000. So part of our strategy here is we know that interest rates have increased, and they're talking about increasing interest rates in July and further. So we're not going to invest everything right now. We don't know exactly what these interest rates are going to be like next month and so on. So we're just going to develop a ladder here. We're going to invest part of our money now and then hope that interest rates are going to continue going up, and we'll invest more on the following month and so on. Now, the 2-year note and the 5-year note are paying over 3%, which is outstanding compared to what we've seen here in the past. So we're going to lock in a little longer time on those two there. However, we're also going to leave more money that's available for future purchases longer term. Keep in mind on the I-bond, when January 1st rolls around, we can do another $10,000 at that time. And then if you have a tax refund, you can also put up to $5,000 of your tax refund into an I-bond. Now we're going to take a look at it over a longer period of time here. Again, here's our first month where we started out investing. We did the I-bonds here immediately and our T-notes and a little bit in a T-bill. And then we had the remainder in a money market fund. Our second installment, which could be a month or two later, we're going to be watching the overall economy, what's happening with interest rates. Now we're going to put another $5,000 into the T-bill, the 1 year, and then also the 2-year and the 5-year, and then we're going to wait till 2023 for the I-bond. Now we're going to be hoping that as they continue to increase the rates, they're going to go up. We don't know what they're going to be yet on this second installment. And then depending on how the economy is going, whether the Fed is continuing to increase interest rates, would do a third purchase. By then, our money market fund's down to $30,000. We've added another 10 to the 12-month T-bill, another 10,000 to the 2-year T-bill, and another 10,000 to the 5-year T-bill. What we're trying to do here is ladder in and get the best possible interest rate. So we go ahead and get started now with hopes that the interest rates continue to go higher. We don't know what's going to happen. They start to increase rates. If the economy starts to sputter, they may change their whole attitude on increasing interest rates. We need to kind of start now and then hope that interest rates continue higher as we go here. Now, each person would have to look at their own situation and do what's best for them. Someone might say, well, I'm just going to wait for 2 or 3 months down the road and just get everything all at once and just make it simpler. I don't want to have so much to track and to watch. And of course, that's a good strategy also. For those who have money sitting on the side and you're not wanting to invest it right now, we definitely have some more options on how to get higher interest rates. So we looked at money market funds, T-bills, T-notes, Treasury bonds, and the I-bonds. So there's some good opportunities there to get a higher interest on our money. So I want to thank you for watching. Again, if you have any comments, leave a comment. Let us know what your strategy is. And stay tuned for our next episode.